and forensic accountant here, Peggy Swearingen. She is a CPA, business appraiser with Torrey Partners, torreypartners.com. She's going to tell us about tracing a little bit further.
Sure. So Lee hit a lot of the great points in her discussion there, because that is one of the things to keep in mind is the cost benefit of tracing. Mm-hmm. So if you're looking for $20,000 and it's going to cost you 10, 20, 30 to get it, it's not worth doing the analysis, because one of the things you have to keep in mind is half of that asset, half of that 100,000 is yours if it's community. So you're really just trying to get the other 50,000. And even if you do tracing, you may or may not be successful, because everything could be commingled so much that it's just impossible to trace it. But you may not know that till you're, even a few $1,000s into it. So a lot of cost benefit comes into the tracing analysis. And we do sit down with our clients and explain that to them. I have talked clients out of doing tracings before because it's just not worth it. Recently, a client had all these investments, thought big chunk of these 5 or 6 accounts were his separate property. I did kind of an overall analysis, and I said, well, one of these 6 is probably worth going through and spending the money and doing the tracing, and the other 5 really aren't. And so he said, okay, do the one and we'll not worry about the other 5 or whatever it was. So I do try to encourage clients to look at that, as well as the attorneys do in the process. And Lee's right. So I kind of stepping back, the sources of separate property are any assets that you come into the marriage with. So if you own a residence prior to the date of marriage, and then inheritance, as Lee mentioned, and then also gifts. If your parents or great rich uncle are giving you gifts, then that's your separate property too. So those are the kinds of things that we would trace.
Got it. We're talking with Peggy Swearingen. She's a CPA and business appraiser with Torrey Partners. The website is torreypartners.com. Well, that takes us to business appraisals. Business appraisals. So how do we maintain this big picture focus when involved in a business appraisal?
Okay. So basically, if the parties own a business, it does have a value, and it needs to be included in the community estates when we're divvying up the assets. So then it comes to, what is that value? So we look at the earning stream of the business and also the assets and liabilities of the business. So if somebody were to come to me, say they owned an auto mechanic shop, and I'm going to use the husband in this case, was the mechanic. He's also running the shop. And say the business kicks off about $60,000 of earnings. I'm going to sit down and say to them, look, he could probably go down the street and make $60,000 a year in earnings, and so this business doesn't really have any value, any goodwill above his compensation. And so then we're just looking at, okay, what's the value of the assets of the business minus the liabilities of the business? And from that perspective, then you can probably come to a settlement much easier on what the value of the business is, because you're not fighting over the things that are involved in the earning stream and stuff like that. So one of the most costly areas of business valuation is what we refer to as add backs. And what we're adding back is the personal expenses, the non-operating expenses that are inevitably run through the business. The meals and entertainment, the travel, the auto, those kinds of things. And so if you get into a big he said, she said, then there's a chance for more forensic accounting that has to be done. We have to dig into, say, QuickBooks. We're looking at credit card statements. All those things add a great deal of cost. And in the end, we either may make a decision on what we think is right, or we may literally run a his and hers valuation and let the court decide. So obviously then we have 2 valuations. So we've added to the cost, not double, but certainly more than if we'd done a single valuation. And so if the parties can agree on how much of the personal expenses there are running through the business, we can add back either a dollar amount, or they can agree, yeah, probably 50% of our meals and entertainment are personal, and you can go ahead and add those back. That saves so much time and so much money if you can get to that point. And the bottom line is, if somebody tells me there aren't any personal expenses, they're just wrong. So I've been doing family law appraisals for about 25 years, and that time I valued a single business that did not have add backs. So
Nothing.
Nothing. One out of hundreds.
So he was doing it wrong for sure.
Yeah, they weren't taking advantage of the IRS correctly. So don't tell us they're not there, because we know they're there. The courts expect them to be there, So don't, the sooner you can kind of give that up and move on and get a number, then the better off everybody's going to be from a cost perspective.
Okay, Peggy, let's say that I want to continue this big picture focus, and it's on a case that's financially complex, right? So maybe there's multiple real estate holdings, a business, it's got everything we've been talking about. What are some ideas to bring the cost down and make sure I'm, getting my biggest bang for my buck, I guess?
Sure. In a case like that, it would be a great idea to bring in a financial expert early on, to work with the attorney and to say, okay, so what issues do we have here? Which ones are monetarily worth pursuing? What kind of records we have? Are they sufficient to do what we want to do? All of those kinds of things. And then in that process, to be responsive, to provide the documents, we often have clients who like to stick their head in the sand for a little while.
Sure.
And I can spend money just trying to get the documents and not even doing my analysis. So if they participate and give us documents and make sure they're organized, then that helps the entire process. Especially when it's complicated.
Got it. You must have a good story how you're able to make this thing happen and keep the fees manageable.
Yeah, so as I said before, I often try to, for tracing purposes, try to make sure the clients understand the cost benefit. And then I did have a case where we were doing the valuation, and the client said, you know what, just add back $50,000 a year in personal expenses and unreported revenue, and we're both good with that number. We did. It was great. Got the valuation done at a much lower price than we would have if we'd had to
Piece each one out.
Exactly.
Because fees could be literally double.
Correct.
Double whatever they paid you could be double.
Correct.
To have to figure out that $50,000 number on our own.
Right.
It's that much time and digging through things and going back and forth and whatever you come up with in a contested manner, neither side's going to be happy
right.
with.
No, neither one is going to be.
So it's much better to just come clean, maybe even talk to each other like it sounds like they did, and give you a number.
Right.
Save you so much money.
Yeah, exactly.
We've been talking with Peggy Swearingen. She's a CPA and business appraiser with Torrey Partners. Her website is torreypartners.com. As